The headline for me this week is we had, as I say, 5% inflation year over year in the month of May. That's the highest it's been in 30 years. The real yield is at negative rates that we haven't seen since 1980 when inflation was out of control, and the markets just shrugged it off. How can that be right?
Yeah, very interesting inflation print. Like you said, the CPI basket clearly showing a lot of upward pressure. And to answer your question, why is the market shrugging it off? It's obviously because the Fed is telling us this is transitory, and the market also is believing it's transitory. And that's the reason we haven't seen a lot of movement in the 10-year. And so this is what people are really going to have to get their heads around in the coming weeks as to whether or not this will unlock. Is it really a supply chain issue, as an example, that's driving that? So we have to spend some time thinking through that. But I would separate the CPI basket issue from the wage issue, and I just want to comment on that quickly. I can make a case for a lot of things in that basket being transitory. We are worried about some of the inflationary pressures that we're seeing in wages. You mentioned record jobs available, about over 9 million, the biggest in history. From our portfolio companies, we're seeing some people have to increase wages by 40% to bring people back into the labor market. It may be possible, and this could be good in some ways, that we are at the precipice of a redistribution cycle from capital to labor. And that is going to have some inflationary pressures that we're really going to need to watch. And if that is the case, that will show up in margins of companies. And that's something we have to be vigilant around. So taking that all together, people think it's transitory. The market may be too complacent about this. And we're very, very focused on how it's coming through on wages.
So, Steve, as a major investor, is there a danger we are being too complacent? And go back to the Fed for a second. We all like to focus on the Fed and what they're doing. They have control over things like interest rates, particularly the short end of the curve. They can really affect that. They can certainly affect financial conditions. They can't really determine inflation. They can only sort of predict where it's going. Do we think they have it right?
Well, the Fed can not only predict inflation, they can create inflation, but that's maybe another story. But I think what Katie said at the beginning, all of what Katie said was, I think, dead on, but particularly at the beginning of her answer, she pointed out this disconnect between what many professional economists like Larry Summers, who I happen to agree with, as you know, but also a lot of CEOs and other people outside of the markets think is going on with what the markets think is going on. When you look at what's happening to inflationary expectations as measured by the markets, they remain, to use the Fed's favorite phrase, and famous phrase, they remain well anchored. Whether you look at the break-evens between tips and nominals, whether you look at the forwards, whether you look at the five-year forwards, any place you look in the market, it's suggesting that inflation will remain in the 2.25%, 2.5% range. Many of the rest of us have different views about that, but that's at least what the market thinks at the moment. As and when the facts change, as Keynes famously said, we can change our minds and the market may change its mind. And to a comment you made a second ago, the Fed can control inflation and create it and stop it. But the one thing it really can't do is control the long end of the Treasury curve. And in a fight between the Fed and the markets over what happens to longer term interest rates, not the Fed funds rate, not the 2-year, but when you get out to 10, 20, and 30 years, I believe, and I think history would suggest, that the markets are more often right than the Fed is right. And that becomes a test of wills.
So, Katie, you mentioned inflation, particularly when it comes to wages. What does that do to you as an investment in equities? Do you have to really discern between companies, for example, with smaller margins that might get really squeezed with wage pressure? Because one of the things that can happen in inflation, whether it's wages or it's input costs, you can really hurt the margins.
Yeah, absolutely. And so I think with wages, one thing, the main thing that we have to figure out here is that we know that wages are going up. As I said, we're seeing a lot of data on that from our portfolio companies. We need to, and it's quite an interesting thing because we've actually been able to achieve through this stimulus an increase effectively in the minimum wage that we have not been able to do through policy ever. And so that's in and of itself quite interesting. Then we need to actually see with these wages, is this a one-time reset, or are we actually going to have growth of upward growth on wage pressure going forward? And so that's what we have to monitor. If we have that, it is going to start to erode margins more meaningfully, and that could be negative for equity markets. Just taking one step back here, though, I think what we're seeing in equity markets now as it relates to inflation is that markets are up 13%, so very healthy return for equity markets year to date, but the inflation is playing out what's happening under the markets, obviously with value having strong leadership over growth markets, and that's directly because of inflationary pressures.
Steve, one of the things that we can be concerned about, as you say, the Fed can affect inflation. They can create it. They can also stifle it if they really raise their rates. We actually had Bill Dudley, the former president of the New York Fed, come out in a piece in Bloomberg actually this week and say his big concern is the Fed is backing themselves in a corner. They're staying locked too long on the accommodative policy. They'll have to overreact and we'll get a recession out of this. How do you assess the danger of that?
I saw Bill Dudley's piece, and I've seen other distinguished people like Bill say essentially that every time inflation has gotten away from the Fed, it's resulted in recession. I haven't gone back and checked their history, but I suspect they're right. The Fed does get behind the curve. It's gotten behind the curve in both directions, and this may be a case where it's behind the curve again. I do worry, as you said, that they back themselves into a corner with their insistence that rates are going to remain lower for longer. They're essentially trying to talk down the longer end of the curve, which they don't control, as I said, and try to keep the party going, so to speak. And I do worry a lot about that. Katie is absolutely right about inflationary pressures building up. She's absolutely right about wages rising for people, especially at the bottom, which is a good thing. The question really, as she alluded to, is can business pass this through? And the yin and the yang is you either get lower profits, which is not great for the markets, or you get more inflation, which is ultimately not great for the markets. But either way, cost pressures are not really a good thing for pretty much anybody, except perhaps some workers, which I'm certainly happy about.
So, Katie, let me put you on the spot, if I may. As somebody who manages equity investments, we've got the Fed coming up with their meeting next week. The FOMC has their meeting next week. If you had your druthers, if you were advising Jay Powell, the chair of the Fed, would you say back off a little bit so we start taking a little air out of the balloon?
I think our expectation next week is that we're going to get no news, so they're going to remain on hold. We also don't think they're going to start talking about tapering. We think, in fact, they're only going to start talking about tapering later this summer. I mean, they've projected to us that not only do they want full employment, so we've talked about a lot of jobs on offer, but we should also recognize that we still have an unemployment rate of 5.8%. So Steve and I can unpack that a little bit more, but we still have a healthy unemployment number, if you will. And in addition to that unemployment number, the Fed is looking to close that, but also to have more inclusive growth. And we're not quite there yet. And so we expect an accommodative policy. And of course, that should actually be quite constructive for the performance of risk assets if that is indeed their position next week.
But Steve, just to wrap this segment up here, is accommodative policy from the Fed having any effect on people actually getting jobs? I don't see it right now.
This gets into the whole question of the disconnect between the number of jobs openings, which, as you know, is at an all-time record, over 8 million open jobs, with the fact that that you still do have a unusually high unemployment rate, as well as 3.5 million, I think it is at the moment, people who've left the labor force altogether. And this is a robust debate. We could have the rest of your hour. I'll spare you that. But that's the yin and the yang of this. I do think that there's plenty of anecdotal as well as factual evidence to suggest that people are reluctant to take jobs they don't really want to take, whether it's health reasons, whether it's childcare reasons, whether it's the stimulus money, the UI money, whatever. And so all of that has to play itself out one way or another. And I'm afraid some of it's going to play itself out in more inflationary pressures.